afternoon, people. I'm Kwasa. I'm an analyst at Fusion Forex, and I'm here with you guys today to talk about the basics of the Forex market. Okay, so the Forex market, yeah? How do the Forex markets exist? And can you really profit from them, or are they full of scam? So the Forex market is where global currencies are exchanged, yeah, for other global currencies to facilitate economic activities. So having an understanding of FX gives deep insights that aid in the understanding of other markets. For example, the stock markets, the indices, commodities and futures. This is because the FX market is the most liquid of the global markets, with a daily turnover of $6.6 trillion. That's a statistic from 2020. In 2004, the daily turnover used to be 1.4 trillion. So considering that's only been around 16 years, there's also been a rapid growth in the sector. So who are the participants in the FX markets? The primary participants are the central banks around the world, the commercial institutions, large fund management institutions, brokerages, and retail traders. So majority of the FX turnover, it comes from the commercial institutions and the banks. They themselves, their strategies and their money management is based upon hedging their reserves. So banks and these large commercial players, they essentially make the market we participate. Yeah, they're the ones who avail the best bid and best offer prices for us. So this is because they offer up majority of liquidity, and this allows us, the other market participants, to place bids and offers. So the central banks in the world, there's the US Fed, there's the European Central Bank, the Fed is the Federal Reserve, there's the Bank of England, the Bank of Japan, the Swiss National Bank, the Bank of Canada, the Reserve Bank of Australia and New Zealand. Commercials can cover for multinational corporations and privately owned banks. Yeah, a big example is Citibank. So large funds do not participate in FX markets the same way that commercials and central banks do. Large funds participate with the aim of making a profit. They are given money by investors and the aim is for them to make a profit. So the difference between large funds and retail traders, yeah, is that large funds trade huge volumes and therefore they affect the state of liquidity in the markets. This activity makes them to some extent be qualified to be somehow a liquidity provider, or rather they are closer to the sell side of the whole Forex business. Yeah, so large funds are also more informed and they put more resources into the research of their speculations. So they're generally more profitable than retail investors. Yeah, large funds access and feed liquidity directly via the banks or prime brokerage. For you to get prime brokerage services or for you to tap into prices directly from the bank, you have to be having a certain amount of funds. This is what brokers do essentially, and then tap in some more commission and give the price to us. So price aggregation is how price is centralized and it's collected. It's collected and brought to you as one ticker. It's a single number that you look at in the ticker. So a huge volume of liquidity providers such as banks, commercial institutions, corporates, and the large funds, they constantly aggregate this price. They have an interbank network which is constantly in communication. And the result of the interbank network is a price feed. And that's a direct source of information for most market participants. Retail traders also undergo a curse. Yeah, it's a retail curse of 96% of us being unprofitable. Retails participate in the FX markets, yeah, from an angle of disadvantage. They are generally less informed and less capitalized. People have small accounts. People aren't really sure what strategies they're trading, and they can't even be sure of what market moves could happen based on information they can't even receive. So the fact that retail traders seek liquidity from middlemen, like brokerages, also means that you go through heftier commissions. for you to just have a trade. So for you to be in business as a retail trader, you have to have a market edge. If you don't have a market edge, you'll suffer the retail curse of being unprofitable. That's the idea of learning the basics of Forex and graduating and gradually getting into more advanced concepts. Yeah, so this is a flowchart, and this flowchart is showing us just the business model of the Forex market from the sell side to the buy side. You can see how the business is situated and how the flows happen for price to be aggregated to you, for you to see a price feed. Central banks provide the price, they offer price, so they're in the sell side. The commercial institutions also, since they're the larger participants, they participate from the sell side. They do not access price as a product. They use price for their own trades. They have their own other products. Large funds aren't necessarily on the sell side, but also aren't necessarily on the buy side, because we are not really receiving this packaged end price aggregate as a large fund. Large funds trade directly through banks, and that gives them an edge. That also gives them an edge for the price delivery and liquidity pooling. So on the buy side, we have the retail brokerages and the retail trader. This is where you get the packaged product price from the price aggregates, and this price is what we trade every day, and it's made available to us by our retail brokerages. A currency pair, which is what we trade, comprises of a base currency and a quote currency. So the price of the base currency is quoted in times of the quote currency. This is like in this example, the euro dollar. The base currency is the euro and the quote currency is the dollar. So what you mean when the price is, for example, 128.80, as in this example, for the bid, it means that you can sell €1, 1 unit of the base currency for the quote currency. Actually, you can sell this many units, the bid price units of the base currency for the quote currency. So €1 would go for $1.2880, because the price of the euro dollar is 128.80. Okay, the bid and the ask, these are the bid and ask prices. We've come across the bid and ask prices, and this is the price. The bid price is the price at which buyers in the market are willing to buy from you. So it's a price which you can sell at. The ask price, on the other hand, it's a price which sellers available in the market are willing to sell to you. So when you buy at the ask price, and when you sell at the bid price. So there's normally a difference between the bid and the ask price, and this is the bid-ask spread. It usually caters for the commissions payable to the liquidity provider and or the brokerage. So here's a ticker, here's an example of a ticker, and it's still on the euro dollar. And you can see the price of the euro dollar is, the bid price is 110.51, and the ask price is 110.53. And we can see that the fourth digit, the fourth decimal place rather, has been represented as a pip. This is where we derive the pip value, as we'll see later. And the spread is the difference between the bid and the ask price. That's what the brokerage will charge you as commission. So for pips and the basis points, Forex currency pairs are quoted in terms of pips, and that's short for percentage in points. In practical terms, yeah, that's 100th of a percent, but you don't need to cram 100th of a percent and do that calculation at any given time. You just have to know that it's the fourth decimal place. The fourth decimal place in any price chart shows you a pip, except for the case of the yen. In the yen, the price doesn't extend to 4 decimal places, so we use the second decimal place. Yeah, so a pip is also the same as 1 basis point, and 1 basis point is that 100th of a percent. Yeah. In FX, it's important to know about position sizing, because when you're entering the market, you're normally using position sizes depending on your risk management strategies. So FX market positions are measured in lots. A lot is the measurement of the quantity of an asset. A standard lot represents 100,000 units of any currency, whereas a mini lot is 10,000 units and a micro lot is 1,000 units. So if let's say you have the exposure of a standard lot, that means you're in a trade that is a standard lot. Yeah, that means you have 100,000 units, yeah, of currency. One pip of movement for you will result in $10 of profit or loss, depending on the direction. So we're going to calculate this directly from the 1 pip, yeah, which you remember is the fourth decimal place. So 1 pip is 0.0001. Yeah, when you multiply that by 100,000 units of currency, because now that's a change in price you've had from the time you bought to the time when the price is current, you get 10. Yeah, and that's the $10 per pip for your standard lot calculation. So for a mini lot, if you're using the same formula, it's $1 per pip. For a micro lot, it's $0.1 for a pip. And for convenience, when we're using the trading platform, we represent the standard lot as a 1.00 instead of having to write 100,000 units. But in some special platforms, you might find that they've written them as 100,000 units or in full. So in the platforms we mostly use, that's a MetaTrader, you find 1.00, 0.1 as the mini lot, and 0.01 as a micro lot. There's also nano lots which are available, but not a lot of traders offer those. On to leverage. Leverage is simply the use of borrowed funds to increase your trading position beyond what's available in your account. So when you have an account, you can leverage money that you do not have. You can essentially borrow money from the broker and use that money not to fund your account, but to open a trade that is bigger than your account size. You see here, for example, when we're talking about position sizing, we are talking about 100,000 units of any currency. If you had to buy a standard lot and you needed 100,000 units of a currency, you probably can't afford 100,000 units of a currency with your account balance. But leverage would allow you to open such positions because you'd use the bank's or the broker's money rather, and once you're making your profit or your loss, when you liquidate, you can either be profit or you can be in significant loss. So when you're dealing with leverage, you also have to understand margin. And margin is the amount of funds one has in their account and they have to have in the account for a trade to be opened and maintained. So the amount of margin required per trade depends on the leverage you're using and the position size you've opened. Also sometimes the broker policy, because they might have some policy on certain things, like an asset like metals might have different margin requirements from currencies. So for example, let's say you have EURUSD trading at 1.1. Without leverage, yeah, if you buy a standard lot, which is 100,000 units of euros, you'll need 110,000 because it's at 1.1. You need $110,000 to fulfill your margin requirements. But let's say a trader is on a platform that offers them leverage and they have 1:100 leverage. This means that they can access 100 times purchasing power of their account balance. So from the available capital, they probably just need to have it's going to be $1,100. They'll only need to have $1,100 for them to open a standard lot trade. So leverage, it lowers the bar for entry for trading because it means that you will need less capital for you to be able to profit exponentially from the markets. But it's a double-edged sword in the sense for the thing that makes you make money so fast, or rather huge quantities of money per trade, it can also make you lose just that fast. So here's a conversion table, and we can see various assignments of leverage and what amount is required, the required margin to trade a standard lot. So 100,000 is a standard lot, and on a 1-to-1 leverage, you're going to require a margin of $100,000. When you have a leverage of 2-to-1, you're going to require half the amount. You can use this as ratios. You know that a 2-to-1 leverage translates to the ratio of 0.5. So when you multiply that by the amount of the standard lot, yeah, it's going to be $50,000. And 50-to-1, do the same thing. Yeah, it's a ratio of 1/50. When you do that to the standard, you get $2,000. So if you have leverage of 400-to-1, 200-to-1, you can use only like $1,000 or less than $1,000 of margin. And a lot of FX brokers actually offer you leverage within the range of 200-400-to-1. Some even go to the extent of giving you leverage of 2,000-to-1. So what's the best time to trade in the FX markets? So due to global time disparity, the players in the FX market are active at different periods. Trading activities in a day are grouped into 3 distinct sessions. This is according to the time regions in the globe. There's the Asia session, that's from 12 a.m. to 7 a.m. That's in the GMT time. GMT time is the time, I guess it's at Greenwich, I guess that's London too. Us in Nairobi, we're at GMT plus 3. We'll look at the relevant times for that, but let's just get the sessions in the GMT time first. The Europe session, it starts at 6 a.m. and ends at 3 p.m. GMT. The US session from 12 noon all the way to 8 p.m. GMT. So the Europe session and the New York session make up a majority of the trading volume, and therefore there's 2 3-hour windows within a day where there is peak volume and there is high volatility. And you want to center most of your trading around this peak period because this is when you probably have likely setups and more volatility. You'd get more pips for your setup. So this is when you get a bang for your buck. So there's the first 3 hours of the European session and the first 3 hours of the overlap of the US session, and this overlaps with the European close. So in GMT plus 3, which is the time zone in Nairobi, the Asia session starts at 3 a.m. and it ends at 10 a.m. It's normally not too volatile for most currency pairs. The European session, it starts at 9 a.m. and ends at 6 p.m. The US session starts at 3 p.m. and goes all the way to 11 p.m. So your optimal trading times in like the GMT plus 3, that's a time in Nairobi. For the London kill zone, you're going to be trading between 9 a.m. and noon. And for the New York kill zone, you're going to be trading between 3 p.m. and 6 p.m. That's the optimal time to be trading. So news and market events. So during news events, markets are more volatile. Novice traders aren't advised to be trading news events, and you should hedge your trades prior to high impact news such that you're not risking too much or your trades are at break even at least. Also, during the course of the week, the market tends to move in a schema that's defined by the nature of the news events that week. There's some weeks which might be dry of news, there's some weeks which have news in the middle of the week, like on the Wednesday. You can have days where there's weeks rather where there's news on a Friday. And to be on the safe side, you should consider the larger chunk of the weekly range. And that larger chunk of the weekly range occurs between Tuesday and Thursday, let's say. So trading on Friday normally results in like low volume and probably you don't have the direction potential. So it's not too advisable. It would be quite a statistical advantage for you to trade within the first days of the week, all up to Friday. Okay, trading tools that you require for you to trade efficiently: a charting platform. You can use the TradingView. It's an online platform. You access it through your browser. They also have a mobile app. You can use MT5 and MT4 or CTrader. Execution platforms, the best execution platforms, because they're supported by most brokers, are the MT5 and MT4 platforms, but you can also get some brokers who work with your TradingView. For you to get a good broker, it's a matter of preference. And you should have a news and events calendar. My FX book, Forex Factory, and Daily FX offer quite comprehensive news event calendars that show you even the probability or the priority of the news event. Okay, so I'd want us to look at charts so that we can look at the pips, the basis points in the sessions. Then we can also look at how leverage presents in a real situation. Okay. So here we have a chart. We have a chart of the euro dollar. Actually, this is the pound yen. Sorry for that. So when you have the pound yen, you can see the price here in the pound yen. It's been let's use a regular pair which has 4 decimal points first or more, so that we can talk about the disparity of the yen too. So I'm gonna take the dollar, the euro dollar. Yeah, so here you can see the euro dollar chart, and here's the current price. The price is at 1,722. So if you look at the digits, the fourth decimal place, which is now 1, that represents the pip value of the price you're currently at. When you're using pips, you use pips to measure out the market. So for example, if you have, or if you expect the prices to get from here up to maybe this high, you can measure out the high, and what's the level of the high? It's at 1,748. I'm not reading the last number just to keep it in the 4 decimal places, so that the last digit I say, which is the 8, represents the pips. So we could have a line at the 1,748. Let me just make sure it's on the 1,748. Okay. Yeah. And what we could do, we could measure price from where the market is presently up to the 147.8, 74.8, sorry. So you can see here the terminal says that's 278 points, but the MetaTrader measures in pipettes, so that's 27 pips, because it's going to be the difference from the 0719 to the 0748. Yeah. Leverage. How can we consider this? How can I show you leverage? Let me show you the navigator. For example, this is a demo account that I'm running on. Yeah, it's just to show you guys some few concepts on trading. So let's look at this. You see the information on the trial account. When I hover over the account, it shows me the client and Xness Technologies. That's the name of my broker. And then it shows me the balance, and it shows me 1:1,000. So the leverage on this account is 1:1,000. So what that means is that I have access to 1,000 times the amount of cash that's in my balance. So my balance being 10,240, that times 1,000, that gives me access to that's 10 million. Basically, I have the purchasing power of $10 million on this. What that means is that I can open a trade. This is where you put in the lots. That's a micro lot, yeah, and that's a standard lot. So what this means basically is that I can have an order. Let's just go to the new orders. I can have an order of a volume of up to 10 million. So let's see what a standard lot is. That's 100,000, just like we learned here. So 10, that's 1 million. 100, that's 10 million. So technically, I should be able to buy 10 million. But then more than 10 million, my margin shouldn't be able to satisfy. So let's say I had to purchase 150. I don't think that would go through. Yeah, I'm attempting to do the purchase. You see, it told me not enough money. Sorry for that. Let's try 100. Let's try see if we can buy. Still not enough money, probably because it's in euro. Let me make an attempt, slightly less, maybe 80. Yeah, let's see that, or 90, that could work, 85. Oh, yeah, place an order. We managed to put 85 lots, but that's using quite a lot of leverage, so the fluctuation that it would cause would probably be unnecessary to our balance, and it'd probably blow your account so quick doing stuff like that. In short, that's a stunt. Don't be caught doing stuff like that using high leverage. But leverage can work to your advantage though, if you know how to finesse the brokers, essentially. Okay, so let's get back to the presentation. And I'd like us to talk about the basic market states that are there and have been known for centuries. There's the bull market and the bear market. The bull market condition is when the market is going up, yeah, and the price is going up is coupled with optimism. The bear market condition is when the prices are going down, and it's heavily paired with pessimism. This ties to the cycle of traders. I think on there's a frame where I'll show you the cycle of traders and the emotional cycle that traders go through when the market is in different states. So when the market is trending upwards and it keeps making higher highs, that's a bull market. And when the market is trending downwards and it keeps making lower and lower lows, that's a bear market. Here are some basic candlesticks, and these candlesticks, some of the nomenclature in the candlesticks, it's not too relevant. You don't have to be picking these like off the bat to be making any kind of profit, but they do help you have a language of sorts to communicate with other traders so that you can identify levels easily. So it's quite convenient and quite nice to know them as a trader. It just shows how informed you are. Yeah, so when you're looking at candlesticks, first of all, the body of the candlestick, yeah, is the fact that a candlestick has a body and a wick is the reason why we call them candlesticks. You can imagine, come on. So when a candle has an open, which is higher than its close, that's a bearish candle. And when the candle has an open which is lower than the close, meaning that it closes above its open price, that's a bullish candle. A bullish candle is showing price increase, and a bearish candle is showing price decrease. So when a bearish candle, or rather when we have the candle having the same open and close price, the candle is a doji formation. Sorry. Yeah, so when a candle's open and close are the same price, the candle is said to be a doji formation. Yeah, basic bullish reversal patterns. Yeah, these are patterns that we'd expect when the market is trying to turn bullish. Yeah, the patterns that we find at the bottoms, at the lows of markets when bullish moves about to begin. Yeah, it would be a hammer. And the reason for it to be a bullish reversal pattern is the psychology behind it. What this means is that price had an open, yeah, and price went down during that period. Let's say it's a 5-minute candlestick, and then price came back up and closed above the open again. So that would show that price is potentially reversing. Actually, if you're able to divide that time frame into a smaller time frame, you might be able to find a bullish engulfing, because you'll find an open of one candle, price goes down and closes below. Then in the next candle, the open is below here, and price comes and closes above the initial open. That's basically the same structure. And if the first open and the last close occur at the same level, it's going to form a mariposa. And if it sort of formed a double bottom in like a smaller time frame, it's going to come up with a tweezer, because the first open, then low, then close, then the second open, then low, then a close above. Yeah, it would give us a W formation, which would be a double bottom. So a morning star is when it starts with a down move and has a doji or an indecision candle, and then a candle coming back up. So the market went bearish, had a moment of indecision, then came back bullish. That's probably a sign of a reversal. So for bearish reversals, it's basically just the same case, but the inverted, and the inverted hammer is a shooting star. The inverted bullish engulfing, of course, will be a bearish engulfing. Tweezer bottom, tweezer top, morning star, evening star. Yeah, makes perfect sense. So when you're looking at candlesticks, you can judge the strength of candlesticks from simply looking at the ratio or the proportion of its body to its wicks. Remember the bodies and the wicks. Yeah, so if you're looking at bullish candlesticks, yeah, the most bullish candlestick will have a more full body. You can see that it's more full bodied than this candlestick, and this is showing that there's more bullish strength. One which has some slight wicking could be indicative of less bullish strength, and the proportion of the wicks to the body would be directly proportional, yeah, to the strength. So as you reduce the size of the body, you'd be getting less bullish strength. And a neutral candle is a doji. The doji is the indecision candle. When the market forms a doji, it means that one, the orders have rested and been absorbed, so it either means that people have decided that this is a price that's okay for this asset, so that's neutral, or there is no decision that's been made to either go up or to go down. So that's what the doji symbolizes. And for the bearish candles, same case. So you can think of a large full body bearish candle as really bearish, and one which has smaller bodies as one with less momentum. So here the indecision patterns, you can see it's a doji right at the center, and you can have different adaptations of the doji. There's a dragonfly doji where the price opens and closes at the same level, but it has a low which is lower than the open and the close. You can have a gravestone doji where the price closes and opens at the same level, but it has a high. Yeah, so there's also a spinning top, which is basically just a doji with a slight body. I think it depends on the kind of strategy you're trading, but the amount of body that you need to consider something a spinning top, yeah, I guess it's something relative. It's a subjective affair. So here we have some bullish patterns. They normally show you some continuation, and I have a favorite in the 3 white soldiers and the 3 black crows. Whenever you see this, it's highly likely that the market will continue in that direction. Yeah, let's talk about some investing basics. The idea of investing here is to buy cheap and sell high. Basically to buy at discount and sell at premium. So if we take a short trade, yeah, the idea of a short trade is to sell, and you're selling for a profit. So you're not selling something that you have, but then you're acquiring it at a certain price to sell, and you're going to give it at a lower price to pocket the profit. Yeah, when you buy it back for cheaper, you're going to profit, because if you sell fast, you have to buy out of your position. So let's say if we take a short trade here, it is a good idea to acquire positions here when they are highly priced, when it's premium, and dump the positions when we are cheap in price range, when in the discount. So a price range is a subjective frame of reference, and a price range can refer to the high and low of prices within a certain time period, or it can refer to the price between a significant high and a significant low. You can look at these different types of price ranges just in a bit. Another concept that's in the markets, and it's a basic investment concept, is the idea of volatility. So in simple terms, volatility refers to the price fluctuations of an asset. It measures the difference between the opening and closing prices over a certain period of time. So you can say that a certain period of time can get more volatile, or a certain period of time can be less volatile. Like when we talked about the sessions, we mentioned how the overlap between the London and New York session is the most volatile period. And for this to be the most volatile period, it means that you measured out that period, and yeah, you could say that the ranges of the candles were probably more, so the candles were covering more range, and yeah, that translates to more volatility, more market fluctuation. So an example is a currency pair that's fluctuating between 50 and 100 pips. That's a larger fluctuation than one that's doing 5 to 10 pips. So we say that one's more volatile than the other one, which is now less volatile. Another concept is liquidity. So liquidity in the trading context refers to the market's ability to allow assets to be bought and sold easily and quickly without affecting the market price. So the market price of a stock is highly liquid if lots of it can quickly be bought or sold, and the trade has little impact on the stock. So if you can buy a lot of currency, let's say you come in and buy 200,000 or 2 million, because these guys, the institutions really be buying a lot of these lots. So if you're buying huge lots and then the market doesn't move in reaction to your buying, that means that market is highly liquid, so your orders are satisfied easily. Yeah, so there's little price impact because price doesn't have to run far to seek a counterparty. Yeah, so basically anytime you're entering the market, since it's an order-driven market, your order has to be met with a counterparty. And basically if you're buying, someone has to be selling to you. And if you're selling, someone has to be buying to you. So for the commercials, this is a larger activity, and this is what causes price movements, you can imagine. So for them, if you're putting your money in the market and the market is causing a price run, it shows that this market is liquid. But if you can put your money in the market and try and transact, and there's no price run. It's a liquid and more stable, more preferred asset. Yeah. So the same is as low liquidity state. So low liquidity state is when transactions can't be fulfilled with ease, and this results in strong price impact. This causes price imbalances. When prices move from one region or one accumulation of price, like one price range to another, that's called an imbalance. That's a price imbalance. So we can compare liquidity and volatility, since they all try to make us relate with the flux, or rather the flow of money. So a market's liquidity, it has an impact on how volatile the market prices are. Lower liquidity usually results in a more volatile market and causes the prices to change drastically. Higher liquidity usually creates less volatile markets in which prices don't fluctuate as drastically. So we know that volatility is market movement. When there's no liquidity in the market, like when you can't really trade at a certain price and the market is in that price, if someone puts big orders, the price will have to seek liquidity. So since it's in low liquidity, it will have to go to where there is liquidity, resting liquidity elsewhere in the market. So lack of liquidity causes volatility, and price pushes to the illiquid side of the market, the side which doesn't have the liquidity to satisfy. That's where the direction of the price will be. So volatility is a function of liquidity, basically, from what you can tell. So let's look at premium and discount and dynamic and fixed range in prices. Okay. So here we are. I remember we bought 85 lots of the euro. We're actually in profit. We're in mad profit. We made a bank. It's a demo though, so it's come from 9K or 10K, wherever it was. I think that's the commission that we're charged. And now we're at 16K, almost 17K. Let me just close this trade. It's a risky trade for no reason. But you see, this is an example of when leverage works in your favor. Okay. Close the trade. So we were going to look at the premium and discount, and we're going to check out different states of volatility. So let's define a price range. One way to define a price range is simply to look into the markets and spot highs and lows. So for example, in this market, we can spot this high. We can spot this low. We can spot another high right here. Another low. Another high. Another low all the way down here. Another high. Oh, look how the euro has spiked. We could have even left that trade on. It'd probably been more profits. Could have tripled that account, all on scary leverage, but it's cool. We live to trade another day in the demo. Another low. And let's highlight this as the last high. A high. So a price range would basically be, or any price range, we can refer to any price range here. We can refer to any price that's between a high and a low. So this, from this high to this low, can be a price range. From this low to this high, that can be a price range. From this high to this low, that can be a price range. So we use price ranges to refer to price. Like this range up, when price is coming back down, we can say, price is within this range. From this low to this high, price is within that range. And also for this range up, when price pulled back, we can say that price is within this range. So also when you're looking at this market, you can see like the varying states of liquidity that occurred in the market, like throughout various periods. Like for example, this is just this week, so we can see that this line is a Sunday gap. This is Sunday gap, and this is Monday, Tuesday, Wednesday, and this is today, Thursday's trading on the 9th. It's the 9th of June. So on Sunday, actually on Friday last week, all up to Monday early, I bet there was no much flows, so there was barely any liquidity. No, there was barely any volatility in the market. But the market stayed liquid in one region. The market stayed in one spot. That's a blow on the euro. Interesting. We actually came out before the prices went smack in the opposite direction. Yeah, so anyway, I was defining a high liquidity state here. That's right here where the prices are rather stable. It's like everyone's agreed to trade around these prices. And you can see when the markets get volatile, it's because they can't satisfy the liquidity. And once they get to satisfy the liquidity and they fall into a pocket of liquidity, the markets become more stable. They stabilize. And they stabilize until the liquidity state changes again, and that provokes another price run. So the market is in a constant changing state of volatility and liquidity. It's a continuum. Yeah, I actually forgot to talk about the fixed time price range. So when you're thinking about price ranges, you can have a fixed time price range because you can consider a daily range. For example, you see these price divisions, the vertical lines, they each represent a day. So you can consider the range of yesterday's prices, which could run from this red line high to that red line low. And you can say that was Monday's price range. Yeah. Also, one thing that is popular with a bunch of traders is that you can measure the price range over 20 days. And 20 days in the FX markets, it's roughly the price action that's occurred within a month. That's 4 weeks, because we don't trade for 2 days in a week. So when you compound that over a month, you have 20 trading days, and the rest of the days aren't trading days, and they fill up a month. So if you take 4 divisions from the 4-hour chart, that's technically a month. It would be safe to say that you're highlighting 20 days. So this is a 20-day range in price, and you can consider the monthly prices, and this would be the monthly range, and you can consider the monthly premium and the monthly discount when you're in your trading. Yeah. Okay, so let's talk about order types. The term order refers to how you enter or exit a trade. Different brokers allow for different types of orders. There is the market order, which is an order to buy or sell at the best available price. Yeah, that's how you buy or sell at the market price. So for example, if the euro was at 121.40 and the ask price 121.42, yeah, and you press buy, you'd have to buy at the ask. Remember, you buy at the ask and you sell at the bid. So you'd have to buy the ask of the 121.42. And when you click buy, the platform will just place your buy order instantly at that level. So there's also limit orders and stop entry orders. So a limit order, it's an order where you buy below the market or you sell above the market. So essentially, if you're in a buy limit, you can see this diagram here, you place the order below the market price and you expect the price to go up. That's a buy limit. So the price will tag your limit and go probably in your direction, and that would be anticipation. Actually, what you'll be anticipating is price to tag your limit and it goes in your direction. So for the sell limit, you place the order above the price, and what you anticipate is that price tags into your order and goes down. So there's also a buy stop, which you place directly above the price, and it's to buy. So you can place an order to buy above a price. Maybe you wanted to buy a breakout. So you place the order and the order is tagged, it's triggered, and the market goes through it. A sell stop order is an order to sell that's also below the market price. The stop loss order is a special type of order. Yeah, it's linked to a trade and it's for the purpose of preventing additional losses. If prices go against you and you're in a long position, there's a sell stop order that acts as a stop loss. It's a sell stop. If you're in a short position, it's going to be a buy stop order, because if you're selling, you have to buy out of your position, and if you're buying, you have to sell out of your position. Yeah, so if you went long, for example, at the 122.30 level in the euro, and you put a stop loss at the 122.100 level, if you're wrong and the euro drops to the 122.100, your trade platform will just execute a sell order to counter your buy order and close you out of the position, and you'd have lost 30 pips. Yeah, so there's also a take profit order, which is placed where you want to liquidate your order in positive profits. So the take profit is, yeah, it's above the price. Like if you're buying, the stop loss is below the price and the take profit is above the price, and they both take you out of the trades. Okay, so let's look at the orders in the market. Yeah. The euro seems to have a spill. I guess we've had some digits from some event. Yeah, there's been a news event. That's why the euro has gotten quite volatile within the last 10-15 minutes. Yeah, so the example of the orders, let's say we looked at this price and we wanted it to go way above, and we're like, yeah, this price will probably break this high. We'd place a buy stop order above the price, like that. What this would mean is that when price comes and tags this, it would go through as a buy. Also, if we thought that maybe price would keep falling down, yeah, and keep going down, like for the rest of the session, we'd have to put a sell limit order. Actually, a sell stop order, because we're going below the price. So the sell stop order would come down here. And if the price tagged it downwards, it would go in and be in a sell order. So, for example, if we thought it would go up, but we think that the price would still give us a retracement before it starts going up, we'd probably put a buy limit order below the market price, right here, like this. And if the market pulls back down, it will trigger us in before it goes back up. Funny, it's tagged us in. Yeah, so we can also have a sell limit order. If say we wanted price to reach the top here and sell, we would place a sell limit order there, and when that price is tagged, we'd be in a sell trade. Yeah, so that's basically the order types. Of course, I haven't shown you the stop order. Let's see an example. Let's say at this instant, I sold at market. It's opened a trade that's selling here. It's a second trade. Let me just close the other trade so we're not confused. Let me also close the limit orders. Yeah, so I have this sell, and if I had to protect myself, since I've already sold, I'd drag upwards for my stop loss. You see, the tag says SL, and I'd drag downwards for my take profit. So if the price came down and tagged my take profit, I'd be tagged in for profits, and if it hit my stop loss, I'd be out of the trade, but with the loss controlled, because there's a possibility the market could go way beyond the level I'd predict. So the point of the stop loss and the take profit orders is just to protect you and to make sure that you don't have to sit and constantly be looking at the prices in the market, constantly looking at charts. You can tend to other business, meanwhile, while your trade pans out. Yeah, so I want to finish this presentation with a thought experiment on a price run. Basically, we're just going to have a simple exercise where we study order flow. So for us to study order flow, we have to consider the depth of the market. The depth of market is a measure of the supply and demand for liquid tradable assets. So basically, the depth of market is like a big book that is showing you the orders, the number of orders that are open, that are in the market, above the price and below the price. That's what the depth of market is. So it's based on the number of open buy and sell orders for a given asset. The greater the quantity of those orders, the deeper or more liquid the market is considered to be. Remember how we relate liquidity and high liquidity to more orders or more participants. Yeah, so to trade in the FX markets, one doesn't need to have in-depth knowledge on the depth of market for analysis. You don't really need it. Most brokers actually won't give you any information on the depth of market. But understanding how the depth of market affects the market pricing, it'll give you insight into how price works in order-driven markets. And FX is primarily an order-driven market. So understanding how this depth of market works would help you understand price better. So here's an example of a depth of market. And for this depth of market, you can see it has two sections. It has one table on the left and one table on the right. The table on the left is showing us orders as they're streaming into the market. So we are seeing they have a time tag, and these orders are streaming into the market. They sell orders and buy orders, all kinds of orders. And then the table on the left, it's the current market. This table normally moves, and it shows you the current market price, and the orders resting above the market and the orders resting below the market. So it shows us the orders below the market, which are buy orders, and the orders above the market, which are sell orders. So basically it's showing us the liquidity in the market. We can see that there's different volumes at different prices. From the current market price, if you go upwards, there's different volumes of sells. You can see here there's 296 at the 9500, there's 97 at the 9470, there's 401 at the 9400. Yeah, so basically this is the depth of market. This is how it presents. So in our experiment, we're going to consider a certain patch of the market, and we're going to have a hypothetical depth of market right here on the side. So we can see this is the current price in amber over here. This is actually peach, not amber. Yeah, this is the current price, and this is a price range that we're observing. So let's say that institutions or a big commercial, or rather the banks, the people who can load enough into the markets to actually affect how they move, were observing this market. Yeah, and in observing this market, they were analyzing to see how they could trade their own money. This depth of market would essentially mean that in this range, which I've lined out, the bids and offers, which are basically the sells and the buys, are lining up. Here it's hypothetical. I've put a 10, 10, 10, 10, 10, 10, just so that you can see there's an equilibrium. And if you have this sort of equilibrium in buyers and sellers, we'll also have an equilibrium in the prices. So you can see the price maintains that range. So let's say the large institution came around and they wanted to place a commercial order. Maybe they were transacting in foreign exchange for like trade between countries, or maybe they're a big bank and they had to, do some float activities. So let's say this commercial order is 60 units, and the purchase of 60 units is coming in at the current price. What this would do, it would mean that in this order right here, which is a 10, you'd have 60 more units. How would this order be fulfilled? For you to be a buyer in the market, you need someone to sell to you. So if I come into the market and I have an order for 60 units, it's going to need to be satisfied by 60 units being sold. So here you can see it's the aftermath, and after the 60 was added, it became a 70 at this level, and you can see a price run that ensued. So the price run occurred because what happens is these 70 offers, they have to be fulfilled before price can settle. And for this to happen, price will have to tick up and find more sellers, because the more sellers will be in higher levels. So price will tick up through this first 10 to be a 60, then here 50, 40, 30, 20, then it would tick into the 100 as a 10. So we hadn't even talked about this before, but it's been there, even in the first tag. In the bids at a certain level, we also had a commercial bidder who was already bidding, or rather selling 100 units of whatever this asset is. They were selling 100 units at this higher price that's way up here. So the buying of the commercial orders caused a price run, which now triggered his bids, which were resting in that level. So him being a seller now in the market, he needs a counterparty. And we've already satisfied this counterparty. This have already run out in the up move. And you can see while that was happening, there were no more buyers left in the upper side of the market. So there's no one to offer up to this guy's bids. He has 100 bids and there's no one to offer up to. So what this will result in is price will run back down, and it will run through the void that it created when going up and running out of offers. So price would run back down, until the point where it will be able to satisfy. It would go down clearing orders until it's able to satisfy the 100 bids. So that's an essential mechanism that propels the market. That's how order-driven markets would hypothetically work under a depth of market analysis. But it's simply a thought experiment. It just gives you something to think about, and it's a takeaway. It's just a bonus takeaway from the video and the introductory class. So I'd like to thank you for your attention and your time. This is a hefty amount of time, and it's quite, it's not an easy task to just articulate all this knowledge and put it into one place just for you. So definitely this is beneficial for you and your trading. And I guess I'll see you in another video where we talk about more advanced concepts in trading, and we can come to define a strategy which you can later use in the markets on live funds. Thank you.